Could Applied Digital Corporation, APLD, be actually laying the foundation for the next great AI infrastructure empire? Or look, are we maybe looking at a super high stakes gamble, one fueled by just immense ambition, significant debt, and, well, the future hopes pinned on this whole AI boom? As of August 25th, 2025, its stock is trading around $16.05. And today, we're diving deep into a company that really sits at this fascinating crossroads of massive opportunity and, frankly, equally significant risk. Welcome to the deep dive. This is where we take your sources, articles, research notes, whatever you've got, and we distill the most important insights. We give you that shortcut to being truly well informed. Our mission today, to thoroughly explore APLD. It's a really fascinating case study in the rapid, sometimes dizzying evolution of the AI infrastructure market.
Exactly. And this deep dive is going to guide you through Applied Digital's really dramatic pivot. We'll dissect its current financial health, examine the prevailing market sentiment, and ultimately synthesize the powerful bull and bear cases for its future. We're going to break this down into two main parts, covering 7 distinct chapters, just to ensure you get a comprehensive understanding of what is, an incredibly complex story.
Right. We'll begin by establishing the groundwork. So in part 1, we'll kick things off with chapter 1, the business of AI's foundation. Then we'll move into chapter 2, management evaluation, and round out this first section with chapter 3, financial analysis.
And then in part 2, we'll broaden our perspective. We'll look at chapter 4, market sentiment, chapter 5, ownership structure, chapter 6, risk assessment, and finally we'll bring it all together in chapter 7, conclusion.
Okay, perfect. So with that roadmap laid out, let's jump right into chapter 1, the business of AI's foundation, understanding Applied Digital. Now, this company, as you mentioned, started out deep in the crypto world, but they've made this massive pivot. What exactly is their core business now, in this age of AI?
Well, Applied Digital has gone through a really profound transformation. They began as Applied Blockchain, Inc., and their focus was primarily on crypto mining hosting. Very different world. But they've aggressively pivoted. Now they're a specialized designer, builder, and operator of next-generation data centers. These are purpose-built for high-performance computing, or HPC, and AI workloads.
Okay.
And the crucial insight here, I think, is their revenue model. It's shifted from that highly volatile crypto market exposure to much more stable, multi-year, long-term contracts.
Right, that makes sense.
Take their landmark 15-year agreement with CoreWeave, for instance. It positions them much more like a specialized real estate or infrastructure landlord, but specifically for the AI age. They've even got this cloud services business they've classified as held for sale, which just highlights their laser focus on the core HPC mission.
That is a huge shift. But when you say data centers, what exactly are they selling? Like, what's the specific value proposition for these huge AI companies that need just mountains of processing power?
Yeah, good question. Their core product isn't software, and it's not even just generic cloud space. It's purpose-built, high-power density data center capacity as a service. So that includes the physical building, access to truly massive electrical power, touching hundreds of megawatts per campus,
Wow.
and sophisticated cooling systems. Some are proprietary, even waterless solutions, which are absolutely essential for the intense heat generated by these GPU clusters.
Right, the GPUs run incredibly hot.
Exactly. So the key insight here is they're not just selling space. They're solving a critical, complex bottleneck: the extreme power and cooling needs of modern AI, needs which traditional players can't easily replicate at this scale. This offers clients, speed, expertise, and capital efficiency. It effectively converts their clients' massive capital expenditures, CapEx, into more manageable operating expenses, OpEx.
Okay, that clarifies their niche. It sounds pretty specialized. So given this massive demand for AI infrastructure, how large is their current footprint and, where do they actually stand against other players in this booming market?
So as of their latest filings, APLD operates around 286 megawatts of capacity. But their market position is really defined by their ambitious growth plans. They have Polaris Forge 1, that's a 250 MW HPC campus. And then there's the recently announced $3 billion Polaris Forge 2. That's designed for an initial 280 MW, but it's scalable beyond that. Both are near Harwood, North Dakota.
$3 billion, wow.
Yeah, and successful execution of these projects would significantly elevate their standing. This strategic direction even earned them Best Data Center in the Americas 2025 by Data Cloud. And this pivot, by the way, it's timed perfectly with two massive trends. First, the Bitcoin halving in 2024 really squeezed crypto miners. Second, the explosion of generative AI created this unprecedented demand for GPU computation.
Right, the timing seems impeccable.
It really does. Sort of traditional cloud providers, they simply can't build fast enough. It creates this lucrative gap. And we're talking about major tech companies. Microsoft, Amazon, Meta projected to spend nearly $381 billion on AI-related CapEx in 2025 alone. And much of that is for precisely this kind of infrastructure APLD provides.
Okay, 381 billion, that's a huge addressable market. But even with this demand, it's not an empty field, right? Who are their main competitors? Does APLD really have enough of an edge to thrive against, say, the established giants and maybe other pivoting players?
No, it's definitely not an empty field. Competition certainly comes from multiple angles.
Yeah.
On one side, you have the established data center REITs, that's real estate investment trusts like Equinix and Digital Realty Trust. These guys have global scale, deep customer relationships.
Yeah, the big guys.
Exactly. Then on the other side, you've got other AI infrastructure specialists and even some of the pivoting crypto miners like Riot Platforms and Core Scientific are trying to get in on this.
Yeah.
Now, APLD currently trades at a substantially higher price to sales, multiple 22.84x trailing compared to many peers. But its current gross margin, around 29.64%, is actually lower, which sort of reflects its development stage.
Interesting dynamic. High valuation, lower current margin.
Right, so it raises the question, what truly sets them apart? Well, the barriers to entry for these large-scale HPC data centers are exceptionally high. You need immense capital, multi-billion-dollar projects. You need to secure multi-hundred-megawatt power at scale, which takes years. And you need highly specialized technical expertise.
Okay, so it's not easy to just jump in.
Not at this scale, no. APLD's competitive advantages seem to be its first-mover execution in securing a multi-gigawatt power pipeline, specifically in strategic locations like North Dakota. And, crucially, its sophisticated financial structuring. That project-level preferred equity investment with Macquarie Asset Management is a prime example. It secured a massive capital without, catastrophic dilution to existing shareholders.
That first mover advantage and the financing, especially that Macquarie deal, sound absolutely critical. Okay, now, a company going through such a radical transformation, it's really a bet on its leadership. So let's move into Chapter 2, management evaluation, the architects of the pivot. Who's actually at the helm here, and what's their track record when it comes to delivering on such an ambitious vision?
Yeah, good question. The strategic direction comes from the chairman and CEO, Wes Cummins. His background is more in technology investing and capital markets. He's the one who identified the AI infrastructure boom early and really spearheaded this pivot. He does boast an impressive track record of building at speed, overseeing 500 megawatts of data center capacity in just 2 years, between 2021 and 2023.
That's fast.
It is. However, it's important to note the company isn't profitable yet. And that points to ongoing operational efficiency challenges that they really need to address as they scale up. A crucial hire, though, was Laurel Lautrello as COO. She brings nearly 2 decades of data center and infrastructure executive experience from big names like Lenovo and Honeywell. That operational expertise is vital for execution.
Yeah, that operational experience sounds absolutely essential for building complex things at this speed. But, as we're evaluating leadership, it's natural to ask about transparency and, frankly, investor confidence. Are there any red flags for investors that we should be aware of here?
Well, while the company provides standard investor communications, quarterly reports, calls, etc., there is a significant concern from its latest fiscal year 2025 10-K filing. They disclosed a material weakness in its internal controls over financial reporting.
Oof, okay. Material weakness, that's never good.
No, it's a serious red flag.
Yeah.
It basically means their processes for ensuring financial reports are accurate aren't strong enough. That can really undermine investor trust in the company's numbers and its operational reliability. Additionally, over the past year, corporate insiders, including CEO Wes Cummins, have been consistent net sellers of APLD stock.
Selling.
Yeah. Now, while some sales are often stated to be for tax liabilities, a lack of open market purchases by insiders can certainly be interpreted by some as perhaps a lack of strong conviction in the near-term upside at current prices.
Right. Those are definite points to consider. So, given maybe some governance concerns there and the immense capital needs of their strategy, what does this tell us about their capital allocation strategy moving forward? How are they deploying the money?
Management's capital allocation is, well, single-minded. It's aggressive reinvestment into organic growth, specifically those multi-billion-dollar Polaris Forge campuses. They're actively divesting non-core assets like that cloud services business we mentioned, just to streamline their focus. They've been extremely aggressive in raising capital using convertible senior notes, at-the-market stock offerings, and that innovative Macquarie preferred equity facility.
They're certainly tapping all the sources.
Absolutely. And crucially, there's no history or any stated plans for share buybacks or dividends. Every bit of capital is being plowed back into growth. The numbers reflect this. Their return on invested capital, ROIC, is deeply negative right now. It's ranged from about negative 1.95% down to negative 17.81% for the trailing 12 months.
Wow, deeply negative.
Yeah, but look, this isn't entirely surprising for a company deploying billions into assets like data centers under construction that aren't generating significant revenue yet. The whole investment thesis here really hinges on a future dramatic positive inflection in ROIC as those massive projects come online and start generating cash.
Okay, let's follow that money trail then and really dig into the numbers in Chapter 3. Financial analysis, a tale of growth and red ink. What do APLD's financials tell us about its current health and its valuation?
Right, so as of August 25th, 2025, Applied Digital's market cap is sitting around $4.2 billion. That's based on its $16.05 share price and about 261.5 million shares outstanding. Now, this valuation certainly reflects immense market enthusiasm for its AI pivot. It's pricing in a lot of future potential rather than current performance.
Okay. 4.2 billion. And how has that potential translated into actual revenue growth? And maybe more importantly, profitability, is there any?
Well, revenue has grown significantly from basically zero in fiscal 2021 to $136.6 million in FY 2024. In FY 2025, it moderated slightly to $144.2 million. That's a 5.5% year-over-year increase. But this slight moderation, it's really indicative of that transition phase before the new HPC projects start billing.
Okay, so a temporary slowdown before a ramp up.
That's what the market anticipates, yes. A sharp re-acceleration in late 2025 and into 2026. Profitability, however, that's the biggest challenge right now. Their gross, operating, and net profit margins are all deeply negative. For example, the net profit margin on a trailing 12-month basis has ranged from -108% down to -160%.
Minus 160%. Wow.
Yeah, heavily impacted by high interest expenses from their debt and various non-cash charges. But look, these figures are quite characteristic of a company in such an aggressive, heavy investment and growth phase. It costs a lot to build these things.
It's quite striking, actually, just how much capital they are deploying, how much cash they're burning through to fuel this ambitious growth.
Absolutely. Their free cash flow, FCF, is deeply negative
Yeah.
and actually deteriorating. It was approximately minus $783 million for FY 2025 and potentially as low as minus $1.03 billion on a trailing 12-month basis.
$1 billion in cash burn.
Yeah, this escalating cash burn directly explains their continuous need for external capital just to keep building. They also have a consistent history of net losses, clocking in at a negative $1.16 earnings per share in FY 2025.
So with all that spending and cash burn, how stable is their balance sheet? I mean, are they building on solid ground, or is it maybe getting a bit shaky?
That's a key question. Their debt-to-equity ratio has ranged between 1.09x and 2.76x. That indicates a high and increasing level of financial leverage and, consequently, risk. Their current ratio stands at 0.77.
Low one.
Right. That means their current liabilities debts do soon exceed their current assets, things they can easily convert to cash. It suggests potential liquidity risk, meaning they might struggle to meet immediate obligations without continuous new financing. And as we discussed, no dividends for shareholders anytime soon.
Okay, so given these really stark figures, the growth story, yes, but also the heavy losses, the significant debt, how do we even begin to value a company like this?
Yeah, it's tricky. A traditional price to earnings, or PE ratio, is meaningless here because of the consistent losses.
Right.
So instead, we look at price to sales, or PS. That's about 13.4x on a forward basis and 22.8x on a trailing 12-month basis. Now, that is a significant premium compared to the broader industry average, which is around 3.36x.
Huge premium.
Huge. The key insight here is that investors are pricing in enormous future growth and execution success, not current performance. For intrinsic valuation, you typically use a discounted cash flow or DCF model, but for APLD, this requires making some really aggressive assumptions.
Like what?
Like a 40% to 50% compound annual growth rate for the initial 5 years, tapering down to maybe a 2% to 3% terminal growth rate. And crucially, you have to use a high discount rate, the WACC weighted average cost of capital, probably in the 10 to 12% range.
Why so high?
Well, it reflects its very high 5-year beta, which is between 5.87 and 6.17. That indicates extreme stock price volatility, much higher than the broader market. and it reflects the significant execution risk involved in building these massive projects.
Got it. So the risk demands a higher discount rate. And what does that DCF model ultimately suggest for a possible value range for APLD shares, considering all these factors?
Based on those aggressive but arguably necessary assumptions, our educational DCF model suggests an intrinsic value range of somewhere between $12 and $22 per share.
$12 to $22, that's a pretty wide range.
It is, and that wide range itself highlights the high degree of uncertainty and the sensitivity to future execution. It really underscores the speculative nature of this investment right now.
Okay, that gives us a good sense of the fundamental numbers and the valuation puzzle. Now, let's pivot to part two and explore how the broader market is reacting to this high-stakes venture. Let's get into chapter 4, market sentiment. A tale of two tapes. It really sounds like APLD is a classic battleground stock, doesn't it?
Oh, absolutely. It's textbook. On one side, you have Wall Street analysts who are overwhelmingly bullish. The consensus rating is a strong buy. The average 12-month price target is around $19.11, with the range going from $13 all the way up to $30.
$30, okay.
Yeah. And news, like that Polaris Forge 2 campus announcement, caused the stock to jump over 15% in just one session. The initial CoreLeave deal led to a rally over 100%. So clearly there's a belief in the strategic vision and execution potential.
That's definitely a strong vote of confidence from the buy-side analyst. But you mentioned a tale of two tapes. What's the bear case telling us? What market indicators reflect that, well, significant group of skeptics?
Right. In stark contrast to those bullish analysts, an exceptionally high percentage APLD's publicly available shares are sold short 27.92%.
Wow, nearly 28% short interest. That's massive.
It's dramatically higher than the peer group average, which is around 5.84%. This deep skepticism among short sellers likely centers on exactly what we've discussed: the company's financial fragility, the high debt, the low current ratio, the negative cash flow, and, importantly, that disclosed material weakness in internal controls. They're essentially betting on significant operational or financial hurdles cropping up.
So they see the risks outweighing the potential rewards, at least at this price.
Precisely. From a technical perspective, however, the stock does show strong positive momentum. It's trading significantly above both its 50-day and 200-day simple moving averages. That generally indicates bullish long-term trends, despite that high short interest. So it's a real tug-of-war between the narrative and the numbers, and the technicals versus the shorts.
That dynamic is certainly captivating. Let's delve into who's actually holding the shares in Chapter 5. Ownership structure. Who sits at the table? Who are the major players owning APLD, and maybe what do their actions tell us about the company's future prospects?
Well, Applied Digital is predominantly institutionally owned now. Approximately 74% of the shares are held by large money managers, think firms like Hood River Capital, BlackRock, Vanguard.
Okay, so the big funds are involved.
Yes, which signifies its move to becoming a recognized player among serious investors. However, institutional trading activity shows that battleground dynamic continues even here. You see some major hedge funds reducing or even liquidating their positions, while others, like BNP Paribas, for example, are initiating or substantially adding to their holdings. It really underscores the divided opinion on APLD's future, even among the pros.
So institutions are clearly split. But what about the people actually running the company? How much do insiders own, and maybe more importantly, are they buying or selling their own stock?
Insider ownership is significant. It's typically cited between 9.3% and 11% of shares outstanding, with CEO Wes Cummins holding a substantial personal stake. Now, normally this aligns management's interests pretty well with shareholders. However, as we touched on earlier, there has been that consistent trend of insider selling over the past 6 to 12 months with no corresponding open market purchases.
Yeah, the selling stands out.
It does. And it raises that important question. Does this signal a lack of insider conviction in the near-term valuation? Or are these sales genuinely just for other personal reasons, like covering tax liabilities from stock grants? It's hard to say definitively, but it's a data point. It's also worth noting that ownership is relatively concentrated, particularly among those top institutional holders. That means decisions by just a few large funds can significantly impact the stock's price, both up and down.
Right. That concentration, combined with the insider selling, definitely adds another layer to the story. Okay, now, no investment is without risk, especially in a sector moving as fast and as capital-intensive as AI infrastructure. Let's move into Chapter 6, risk assessment, navigating the headwinds. Using maybe a SWOT framework, strengths, weaknesses, opportunities, threats, what are the key factors for Applied Digital?
Okay, using a SWOT framework. Strengths. Clearly, That first mover advantage and the dedicated AI infrastructure pivot, they've secured that multi-gigawatt power pipeline. Yeah. Key strategic partnerships like CoreWeave and Macquarie are huge positives. And leadership seems experienced in capital allocation, at least in raising it.
Got it. Strengths make sense. What about the weaknesses?
Weaknesses. The current financial fragility is the big one: unprofitable, high cash burn, weak balance sheet. Then there's that disclosed material weakness in internal controls, which is a governance concern. They lack the operational scale compared to the large REITs. And of course, that pattern of insider selling.
Okay, opportunities.
Opportunities. The massive total addressable market, the TAM for AI infrastructure is just enormous. That's a huge tailwind. There's significant expansion potential if they can land deals with other hyperscalers beyond CoreWeave, and they have the ability to scale operations significantly with that Macquarie funding structure.
And finally, threats. What could derail this?
Threats. Intense competition from larger, better capitalized players is always there. There's extreme execution risk. These are complex, multi-billion-dollar construction projects. Things can go wrong. Yeah. There's significant customer concentration risk with CoreWeave right now. And naturally, power price volatility is always a background risk.
Those are definitely substantial internal and external factors to weigh. How do broader macroeconomic things like inflation or interest rates specifically impact APLD? And are there any sort of specific geopolitical risks we should keep an eye on?
Yeah, macro is important here. Persistent inflation could certainly increase their construction costs for materials and labor, potentially leading to project overruns or delaying revenue generation. And APLD's high leverage makes it very vulnerable to rising interest rates. Higher rates directly increase their cost of capital, the cost of their debt, and they raise the hurdle rate needed for these big projects to actually be profitable.
Right. Higher rates make expensive projects harder to justify.
Exactly. Geopolitically, something like the hypothetical U.S.-imposed tariffs of 2025, mentioned in some scenarios, could impact their supply chain for critical data center components, things like GPUs, cooling systems, power infrastructure. That could lead to increased costs or delays in bringing facilities online. These are all real headwinds that could potentially derail even well-laid plans.
Okay, we have covered a tremendous amount of ground in this deep dive. Let's try and pull everything together now in our final chapter, Chapter 7, Conclusion, Synthesizing the Bull and Bear Cases. Let's try to paint the full picture for Applied Digital.
All right, so the bull case for APLD, it is genuinely compelling when you lay it out. It hinges on their exceptional strategic positioning in this absolutely booming HPC AI market. They have what looks like a de-risked growth pipeline, thanks to secured power and that cornerstone tenant, CoreWeave. They've secured growth capital through that innovative financing with Macquarie. And they possess a first-mover advantage that arguably creates high barriers to entry for others trying to replicate their model quickly.
That bull case definitely paints a very optimistic picture of a company hitting the right market at the right time with the right strategy. But what really strikes me is how starkly the bear case contrasts with that. What are the most pressing concerns that those short sellers, for instance, are likely pinpointing?
Indeed, the contrast is stark. The bear case highlights, I'd say, three main areas of immense risk. First, operational and execution risk. These are complex, multi-billion-dollar projects. Delays, cost overruns, technical challenges. The potential for things to go wrong is significant. Second, financial fragility. The unprofitability, the high debt load, the weak liquidity suggested by the current ratio, the ongoing negative cash flow, it means they're reliant on continuous access to capital markets, which isn't guaranteed. And third, governance and control concerns. That material weakness is a serious flag, and the pattern of insider selling doesn't help investor confidence. Add to that the intense competition and the customer concentration risk with CoreWeave. It really is a high-wire act.
A high-wire act. That sums it up well. So if we look back at our valuation range from the DCF, where does APLD stand today? And what's the ultimate kind of outlook for an investor trying to weigh all these pros and cons?
So our educational DCF model, remember, estimated that intrinsic value range of $12 to $22 per share. Applied Digital's current share price, around $16.05 as of August 25, 2025, falls within the lower middle portion of that range. What this suggests, I think, is that the market is pricing in significant execution success, but perhaps hasn't fully awarded the premium you might expect for a flawless, perfectly executed delivery of these massive projects just yet. There's still some show me priced in.
Right. So it sounds like an investment in APLD isn't a traditional value play at all, is it? It's something else entirely.
No, absolutely not. You're not buying this based on current earnings or assets. It's much more akin to a venture capital style bet. It's a bet on a specific strategic vision and our management's ability to execute against what are clearly considerable operational and financial odds. The potential for multifold returns. It's very real if they successfully transform into a gigawatt-scale AI infrastructure landlord, becoming an essential, almost utility-like asset in the AI economy. However, the risk of significant capital impairment, losing a lot of your investment, is equally real if they stumble, if projects get delayed, if financing dries up, or if competition proves too fierce. The classic high-reward, high-risk proposition.
As this AI revolution accelerates, the demand for specialized infrastructure like Applied Digital seems almost certain to grow. But what does APLD's high-stakes journey really tell us about the true cost and the inherent risks of actually building the future? And maybe how many companies will actually succeed in this monumental race to power the next generation of intelligence? We certainly hope this deep dive into Applied Digital has given you a clearer picture of its potential and its pitfalls. If you found this insightful, please do like and subscribe to the Stock Analytics AI YouTube channel. And remember, Stock Analytics AI members, it's just $4.99 a month, get priority deep dives on tickers. Plus, over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access to those. If you just want a one-off deep dive on a specific stock that interests you, just drop us a super thanks.
And just a reminder, this analysis was generated by an AI system for educational purposes only and should definitely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.